Welcome to Mutual Fund Corner. I'm Avni Raja. Last week we discussed the different types of equity funds that asset management companies offer. On today's episode, let's talk about investing in equity funds and what are the things that you should keep in mind before you do so. A good place to start is by figuring out how much of your portfolio should be allocated to equity investments.
One simple thumb rule to help you is that your equity allocation should be 100 minus your age. So if you're 30 years old, then 70% of your portfolio should be equity oriented. You also need to take into account your financial goals, determine your risk profile and your time horizon based on these goals. When it comes to equity funds, one of the most important things to remember is that you should invest in it with a long-term horizon, ideally more than 5 years.
Now, if you're a first-time investor in mutual funds, then there are two ways to approach it. First, if you're unsure of the risks of equity funds, you can get your feet wet by opting for balanced funds.
Balanced funds allocate about 65% to stocks, which is less than the regular equity funds where equity allocation could go up to 100%. This category of funds is also recommended if you have a medium-term time horizon of 3 to 5 years. If you're sure you want a higher exposure to equities and have a time horizon of more than 5 years, then you could opt for diversified equity funds, which are sector and market cap agnostic. Sectoral as well as thematic funds are among the riskiest of all mutual funds. Between the two, thematic funds are comparatively less risky since they invest across 2 to 3 different sectors, while sectoral funds are focused on one sector alone. However, these categories should be avoided unless you have knowledge of that specific sector or theme. For those who are new to mutual fund investing, it is best to stay away from taking any kind of sectoral calls.
When it comes to choosing between mid-cap and large-cap funds, here's what you should know.
A large-cap fund is more stable compared to mid and small-cap funds, whereas mid-cap funds are usually more volatile and risky. During a bull market, mid-cap funds tend to outperform all other categories but can fall just as rapidly in a bear market. Large-cap funds, on the other hand, may not rise as much as mid-caps, but their downside is restricted during a volatile market.
So to balance it out, you could opt for a combination of mid and large-cap funds in your portfolio. Well, with that, it's a wrap on this episode of Mutual Fund Corner. We'll be back next week with a brand new episode. Until then, if you have any queries, do write into us. And if you like this video, please comment and share. Thank you so much for watching.